Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with my Friday guest, Stephen Dow. How you doing, sir?
Fantastic. And yourself, sir?
I'm doing well. Hey, one of the things, actually, before we get started, let's do that marketing thing first.
Yes. Thank you for remembering. Although I work happily for Velocity Mortgage Capital, all the ideas and topics discussed on Mike's channel are that of our own. So let's get it going.
Yeah, one of the things I'm doing with all of my investors who have been doing their profession for 20 years or more is I want to go back and compare. I want to really compare what we are seeing today in the mortgage market with the nutty insanity of kind of the 05, 06, 07 period. And the reason I want to do this, Stephen, and the reason I want to do this with you is you have an up close and personal history with just how insane and frankly unhealthy that last environment was, because you were in it and then it popped, and you're also in it today. And you're like, and I'm sure you can tell us today's loans have nothing to do with yesteryear's loans, because a lot of people are talking about there's going to be the next great crash, but they're not in it. They don't realize that investors have to put real money down and before they could get 105% loans. And it's so different, but let's remind them you were there.
Oh, no, definitely. I started my career in the finance industry, specifically in subprime, back in early 96. Little boutique shop in Sherman Oaks. And then just kind of progressed from there in the subprime world. Stayed in the wholesale side for a little bit, and then opened up my own broker shop for a little bit. And yeah, was very heavily invested in the subprime market as far as, alt A, stated income, stated assets where you don't have to prove it with any documentation. You just put on an application and they'll take your word for it. Mm-hmm. So it was definitely a higher risk because there was just no leverage, no skin in the game. And I really believe that's the kind of difference between now against then. Whereas before then, you could do a stated income loan on someone's primary residence where you can give them 100% financing. They got no skin in the game and you don't even know what they really make.
Yeah.
So nowadays with the loans that we underwrite, it's for business purpose. So there's a tenant that occupies the space so that even if the property owner stops paying, the tenant theoretically pays enough rent to cover the mortgage payment. So you have less of a chance of default. In fact, our default rate, I believe, I have to check again, but the last time I checked, we had a lower default rate than Fannie Freddie, even though they verify income.
Yeah, this is one of the big things I remember being different. Again, I was borrowing money back then. Actually, one of my loans was an Alt A because that was what the broker at the time put me in. Even though I could qualify prime, I got put into an Alt A loan without, I don't know. I guess I knew, but I didn't know, or I didn't appreciate what it was. And today is, frankly, the liar loans. They don't really exist today, certainly on owner aux, which is awesome. I know this isn't where Velocity plays, so this would be more about what does Stephen know outside. Do you know if any owner aux are getting the 103, 104, 105% loans? Because I remember brokers telling friends and family of mine, we're going to give you all the money for the house and we're going to help you add new furniture. I mean, that was like, I couldn't believe people were doing that. Do you know if that exists at all today? Are you seeing that in the industry?
Right. Well, I don't, not in the commercial finance world. I mean, no, that's just too much of a risk. It's all about skin in the game nowadays. Leverage is what makes our world go around specifically. So even if you could verify someone's income, like I said, back in the mortgage meltdown of 06 to 08 or what have you, most of those loans at default were full doc loans, Fannie Freddie. So for us, if you got, a lot of skin in the game, chances are you're not going to, bolt on the deal, and or the tenant pays enough in rent, so you could at least get that covered. So it's a different animal, and it's a whole different market, but it's still useful just depending upon how you're utilizing that tool, right? Mm-hmm. Just like with anything, if you misuse it, you don't blame the tool, you blame the user, right? Right. Just like with a hot iron, whatever. So same thing with the person with the loan. Even with those, quote unquote, neg am loans in the past, it would be useful if you used it right. But most people were sold it the wrong way as far as looking at it. Like, just a minimum payment. It's like, no, you're getting tacked on in the back end. You don't even see that. You know what I mean? So
it was bad.
That was the problem.
Those pick-up payment loans were the most toxic soup ever created. they were sold all kinds of wrong.
Oh no! Again, it was all about how the person presented it. But if you knew how to use it the right way, you could, depending upon, especially if you're self-employed. You get ebb and flows of income.
Mm-hmm.
Some months, fall back on that lower payment. Other months, pay down, huge principal. So it could be useful, but human nature and just how people were looking at, property values are going to keep going up. Don't worry about it. And no one saw that bubble coming around the corner. So it was just greed at every level, from the securitization side, as far as the rating companies rating these securitizations, and everybody, all the way down to the borrower. I mean, they should pretty much know you're getting something 100% financing with no skin in the game. It's just
it was bad.
I'm sorry, I tend to ramble because there's a lot of PTSD from that time. You know what I mean?
Yeah, no,
this is a lot of happening.
This is what I want people to hear this, because a lot of people are pointing at price charts, not realizing that the underlying asset, which is the loan or the loan product, is fundamentally different than last time. They're not even similar today. So the other thing So the other thing I want to talk about is things changed very fast. And I often refer to it as the Lehman moment, right? When Lehman went under, the world changed. That was like, hey, we're not bailing everybody out. And that's when mortgage brokers started going out. It might be when yours had to close up shop. But I remember that was a time in history where things changed overnight, and they just got progressively worse really, really fast. Do you remember it the same way?
Oh, yeah. Oh, totally. I mean, literally, like overnight, all the banks dried up. There was no products left. And then the few that were there, you try to then, okay, let's pour all your energy into, re-upping the pipeline with whatever product you can sell. And then you pour all your energy, money, marketing, and like a month and a half, 2 months later, they go belly up, and now, you got nothing. So that was a horrible time in finance for sure.
Yeah. How long did it, because I know the property market, I actually didn't go to a mortgage broker or a bank for a decade. Right. I went hard money first, then private money for a decade. I didn't even bother looking because I got told no, I got told no by the bank that had all my money, which I was like, are you kidding me? What do you mean you could say no? And then I got told no by another large national bank. I'm like, wow, something is way off. How long did it take for the mortgage market to kind of start functioning again? Because it was
loosen up.
Yeah. I mean, from the peak of craziness, like you saw in The Big Short, where the guy's eating sushi in Vegas, to, he's getting a job at a car wash company. Was that like several years, or was it just overnight, or what happened?
I mean, for some, it was several years. For some, it was just, even longer than that. It just depended on how much you were leveraged. There was a lot of people that had same, aggressive sentiment of like, picking up a bunch of properties, all 100% financed, and, thinking that the value is just going to keep going up, so then they can refinance in a short period of time and get some equity, yada, 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 and move to the next one. But then once the market crashed and you got no leverage or no skin in the game, they just let all those properties go. So, and some people were just thinking they were paper rich. Look at all the properties I got, but you got no skin in the game. They're thinking they're getting all this equity. And then once that, you got nothing. So, it just depended on the situation and the person. But anywhere from a couple of, at least 6 months or longer for that to happen, from highs to the highs to lows to lows. And then some people even longer as far as years, because they weren't as aggressive and they didn't play too, how do I put this? Just not frugal or smart with their money. I'm definitely, I could say I definitely messed up in regards to that. So just, spend money like I thought it was just going to keep on coming. So lesson learned though, for sure. Things are much more conservative nowadays.
And then the last thing I want to talk about is, how many files were you processing kind of before Lehman goes out? I'm guessing it's a big number. And then like, if you fast forwarded, I just want to get a scale. Like we were doing 80 files a week and then we were doing 6. I mean, just how bad did the water turn off, or the flow of deals? Do you remember?
Oh man. Well, I mean, specifically in the subprime market, it all disappeared. Nobody,
just zero.
All the banks were going belly up, filing BK, and there's no programs. And so Yeah, secondary market wasn't buying it. This stuff, I mean, they were trying to get rid of their stuff at pennies on the dollar, so nobody's buying their stuff either. So you couldn't do any loans. Even on the A-paper side, things are getting even super tight. Yeah. And so for somebody like yourself who's self-employed and you show nothing on your taxes, yeah, there was no way you would have got a loan back then.
Nope. That's why I didn't even bother. Yeah, I get told no by two big national banks. I didn't know any better. I didn't know about non-QM at the time because I don't
didn't exist yet. Because
I didn't think so.
It came about after subprime went away, and then A-paper was still super tight, and the hard money market was still there. But then A-paper started loosening up. But then there was still that underserved market of someone in between conventional financing and traditional hard money. So that's when kind of like a pseudo subprime came about, which now they call non-QM.
Yeah. So one of the big things I guess I want to talk about is we kind of look at today versus yesteryear is investors, right? We have a lot more skin in the game than the 06 timeframe, without question.
100%.
Also today, there's some verification going on, right? I can't fill out my application and you're not going to look at it, right? You're going to check credit. You're going to check this.
I mean, there's still some degree of processing of the file nowadays. At least from our standpoint, we're just primarily looking for a higher quality borrower as far as your credit history. So your credit history kind of explains to us what's the likelihood of repayment, right? Or willingness to, and then the verification of, certain assets of like 3 months of reserves, and obviously your down payment. If you got, from what our statistics and our research and all the data that we've had doing loans since 2004 with this company, skin in the game drives the market. So even if even if your tenant moves out or what have you, if you got 30-40% in that property, you're going to do whatever you can. So that's basically the difference.
I'm guessing you don't have a lot of properties go bad on the Fast 50 program, which is I'm a part of. When I put 50% down on a rental, there's not a very big chance that I'm going to lose that house.
No, not, especially not at 3.99% either, Mike.
Yeah, it's not going to happen.
The numbers don't lie. You know what I'm saying? Statistically, when we give somebody 3.99, and there's no way. I mean, if you're an investor and you can't get an ROI at 6% or above, you should probably find either a different market or find something else to do. Because it should be, cash flowing positive. If those are about the numbers, it should work out. But yeah.
Very cool. Well, Stephen, I appreciate what you did for me. This is always fun to go back. What I really want new investors to realize is today is not 06. Don't listen to people that are pointing at little pricing charts and saying the world's going to end. The loan product, the assets, the lending environment it is night and day different. So, Stephen, how do you want people to reach out to you if they want to ask some questions about your loans?
Oh, yeah. SDAO at velocitymortgage.com. And remember to put ORAAT in the subject line, just so it kind of passes the firewall. But other than that, I work weekends, unfortunately, sometimes. But so call me if you need me, or email me if you need me.
And ORAT in the subject line, in case you don't know what that is, that stands for one rental at a time. So thanks, buddy. Appreciate it.